What is Regulation 28 and why do we have Regulation 28? So Regulation 28 is law that was implemented in 1998 in order to protect pension funds, provident funds, retirement annuities, and all preservation funds. First of all, it's to protect retirement savings from too much risk, ensure diversification and prudent investment, and encourage investments in South African economy. So basically where Regulation 28 comes from is at a point in the past, there was one of these major downturns in the economy, and a lot of people who was going on into retirement in those years then saw a substantial downturn in their pension and provident funds. What happened was that with the market downturn, which was 35 to 40%, an investor would get to retirement, he would have had enough investment in his retirement to retire, and then suddenly, because of this downturn in the economy, because of this crash of the economy and of the markets, suddenly that person had 30 to 40% less. Now the person was still going into retirement, but suddenly they didn't have enough capital to sustain a good retirement income for them. And that is where Regulation 28 was implemented. And Regulation 28 basically wants to make sure that there's enough diversification in terms of investments to ensure that such a major downturn in the economy or in markets won't affect a person as negatively. For this reason, Regulation 28 stipulates that you can have a maximum of 75% in shares, equities in your portfolio, and the other 25% must be split between cash, properties, and bonds. And this diversification, this spread of risk, ensures that it is not as aggressive and not as risky as all-out equity funds. Now, is it good or is it bad? For some people, it is good. For other people, it's not so good. At the end of the day, the most important thing is any pension fund, provident fund, or retirement annuity that you have is a good thing from a growth point of view and also from the tax rebate point of view. Hope that helps you. All the best. Keep well. Bye-bye.